Hello and welcome. Today we're going to break down something that affects almost every professional, salary income. We'll be walking through the key rules, specifically sections 15 to 19, based on the proposed new Income Tax Act for 2025.
So here's a question you've probably asked yourself at some point. Is every single rupee you get from your employer actually taxable? Well, the answer isn't a simple yes or no. It's got some important details we need to unpack. For this explainer, we're diving right into Chapter 4-B of the proposed Income Tax Act 2025. This is where you'll find the absolute core of salary taxation, and we'll be covering everything from Section 15 all the way through to Section 19. All right, so here's our game plan. We'll start with the most important part, the charging section, Section 15. Then, we'll figure out what the law even means by salary. After that, we'll look at the deductions you can claim, run through a real-world calculation, and finish up with the key things you absolutely need to remember.
Okay, let's kick things off with Section 15. Think of this as the gateway to salary taxation. It's the rule that really establishes why your salary is taxed and, just as importantly, when it becomes taxable.
So, Section 15 lays down a critical principle. Your salary gets taxed either when it's due or when it's paid, whichever of those two happens first. The whole idea here is to make sure taxes are paid promptly. As soon as you have the right to receive that money, the tax clock starts ticking, even if the cash hasn't hit your bank account yet. Let's make this super practical. Salary due means the money you've earned. For instance, you work all of March, so your March salary is due in March. It doesn't matter if your company pays you in the first week of April, it's still taxed in the financial year that ends on March 31st. On the flip side, salary paid is just what it sounds like, when you actually receive the money. So if you get an advance for April's salary in March, it gets taxed in the year ending March 31st because you received it earlier.
Okay, so we've nailed down when your salary gets taxed. But the next big question is, what exactly is salary according to the law? For that, we need to look at Sections 16, 17, and 18, which break it all down for us.
You know, the term salary under Section 16 is way broader than you might think. It's not just your basic pay. It's like a giant umbrella that covers everything from wages and pensions to gratuity, commissions, perquisites, and even things like leave encashment. It's designed to be incredibly comprehensive.
Let's zoom in on a really important one. Perquisites, or perks, which are covered in Section 17. A perquisite is basically any non-cash benefit your employer gives you. Think of things like a company car or rent-free housing. These perks have a monetary value for tax purposes and get added to your total salary. Now, how do they put a price tag on a perk like company housing? Well, it's not just a random number. The value is calculated using specific formulas laid out in the Income Tax Rules 2026. For example, the value of that accommodation often depends on a percentage of your salary and even the population of the city you live in.
Another key piece of the puzzle is something called profits in lieu of salary, which you'll find in Section 18. This usually refers to one-time payments you might get when your employment ends or the terms of your job change. A good example would be retrenchment compensation.
Okay, so once you've added up all these components to get your gross salary, the good news is you get to subtract a few things. These are called deductions, found in Section 19, and they help reduce your gross salary to your final taxable income.
Under Section 19, there are two main deductions to be aware of. The first is any tax on employment you've paid during the year, like professional tax, and the second is the standard deduction. This is a flat amount that every salaried person gets, meant to cover small, miscellaneous expenses related to your job.
All right, enough with the theory for a second. Let's see how all of this actually comes together in the real world. We'll walk through a quick calculation and then talk about what you need to do to stay compliant.
Let's walk through this example together. We start with a basic salary of 10 lakh rupees. We add 2 lakhs in allowances and another 1.5 lakhs for the value of perquisites. That brings us to a gross salary of 13,50,000. From that, we subtract the 50,000 standard deduction and the 2,500 for professional tax. And there you have it. The final income chargeable under salaries is 12,97,500 rupees. So what's your role in all this? To make sure your tax deducted at source, or TDS, is accurate, you have a few key jobs. You need to tell your employer about any other income or losses you have and provide proofs for your investments. Under this new framework, you'll use the new Form 12 for this. And finally, always check your annual TDS certificate, now called Form 130, to make sure it's correct.
And of course, it's not just on you. Your employer has a clear set of responsibilities outlined in Section 392. They have to deduct the tax from your salary, give you a statement of your perks using Form 123, file quarterly TDS statements, and issue your annual TDS certificate, Form 130.
Phew, that was a lot of ground to cover. Let's take a moment now to just pause and boil all of that information down into the most important takeaways. But before we get to that final list, let's tackle a question that comes up all the time. What about gifts from your employer? Are those taxable?
The short answer is yes, they absolutely can be. Gifts are considered a type of perquisite under Section 17. The income tax rules set a specific monetary limit for gifts in a financial year. If the total value of gifts you receive goes over that limit, the excess amount becomes taxable. So that nice Diwali gift voucher, it could very well be part of your taxable income.
All right, let's recap the most crucial points. First, salary is taxed when it's due or paid, whichever happens first. Second, salary is a huge category that includes perks and other benefits. Third, you can subtract the standard deduction and any tax on employment. Fourth, as an employee, you need to use Form 124 for your declarations. And finally, number 5, your employer handles the TDS compliance and gives you Form 130.
And that's our breakdown of salary taxation under the proposed Income Tax Act 2025. I really hope you found this explainer helpful. If you did, please do us a favor and like, subscribe, and share it with others who might find it useful. Thanks for watching.
This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.